Welcome to Markets Now. I'm Michelle Rook with Mike Zuzulo with Global Commodity Analytics. Well, after a strong opening in the grains, we're seeing a little bit of mixed trade there, and hogs are mixed with cattle futures trading lower. Mike, let's start off with the wheat complex. It's been the leader the last, 6 sessions we've been up here. We've gotten above some resistance, but are we at a point where you think that we're getting uncompetitive from a global standpoint? Will that set us back?
Yeah, I think the market is looking at the other prices, especially in Europe. One of the things we've talked about before, Michelle, is the idea that we want Europe to be almost the leader to the upside, because that would be the most logical place where Asia would come if they couldn't get it out of the Black Sea or didn't want to get out of the Black Sea with higher prices, maybe tighter supplies. That's not happened. And so that Paris futures has really declined in terms of its premium against the U.S. soft red wheat price, most narrow that I can see since June, July of this year. So that, coupled with the outright French price on the Rhone River being about $20, $30 cheaper a ton than us at this point, with this 90-cent rally roughly from low to high, I think that is beginning to be more of a concern of mine, especially with this WASDE report coming in on Friday, because the world wheat number seems to always be juggled around, and I think the trade's very well aware of that. I certainly am sensitive to that.
So with these price levels now, do you think that infers that China is basically done buying our wheat?
I would guess that they're going to slow down because their currency has started to weaken. The downgrade by Moody's, I think, has been one of those features in this market, not unlike last week, where we had to deal with both positive and bearish negative fundamental news, and the market had to weigh both. And so with the currency being defended reportedly by China's government, with the report coming in on Friday, I would be surprised if they would purchase more wheat here until we got to the WASDE numbers on Friday, especially given that the downgrade by Moody's, while they kept the rating A1, they went to a negative outlook on China's debt, joining the United States, mind you. And I think that really probably would pull back some horns in this market, including maybe some export demand.
So that kind of flies in the face of some of the talk that China maybe has canceled some corn from Brazil and maybe switching to some U.S. sourced corn out of the PNW. So maybe not any confirmation there that we're going to get, huh?
Yeah, this is where I think it's not just about the weather in terms of the crop production potential, but it's still about the weather and getting loads out and getting ships docked and loaded out and shipped out, and not having demurrage charges and being backed up on the ports. And I think that's the tougher part to try and get your arms around or hands around as to why is China buying. And I think part of the reason China is buying is because they need good quality wheat to blend. Australia's had weather problems. China had weather problems last year. India's had weather problems. And so it just doesn't seem like there's a lot of quality wheat around. And we've seen the Russian and Ukraine price go up, 20, 30, maybe $35 a ton since the lows back at the end of October. But at this stage of the game, having bought as much as they bought, I guess it would surprise me that they wouldn't wait until after the numbers come out from USDA.
All right. Well, we rallied early in the wheat market on this additional Chinese SRW business this morning, but a lot of that looks to be worked in now with this mixed trade that we're seeing. Corn market also getting weighed on here by the fact that soybeans and crude oil are both lower this morning, you think?
Yeah, I think the bean oil market is certainly feeling the new 5-month lows in the WTI. We're seeing new 2023 lows in RBOB. The Malaysian palm oil was weaker in the overnight trade. It seems like we can't get any help from the product markets in soybeans. Corn and soybeans do look similar, I think, like you're saying, when it comes to South American weather. It seems like Mato Grosso is going to get some more rains in the forecast on week 2. Second week of the next coming couple weeks. That rain has to be there, though, in my opinion. If not, I think we could even lose more production. So we may be selling it off on better rainfall and better weather. But if that doesn't materialize in a week or so, I think the trade could be right back on a weather market in South America.
Yeah, you have to feel like the rally that we've had in the corn market off of last week's contract lows was tied to the wheat market, but also the fact that we got into the post-liquidation phase here from going into first notice day. And so, that market, do you think it has much legs here, though, in corn going forward?
I would expect corn to be more sensitive to the upside if we had another leg up. A couple reasons. One, you brought up the delivery. It was not as heavy. That meant that the Chicago price did not have much of a premium for sellers to go after. Probably the bigger issue, though, is that 3-year high or peak in net short positions. Almost 206, 207,000 net short positions by the managed money position holders of futures and options in the corn. And I'll be very interested to see what the commitment of traders report shows as far as what they covered here on this recent rally. My guess is not much. Probably the third thing, Michelle, is I still think we can see some better export numbers coming out of the WASDE report, and USDA is going to probably, I think, go up another 25 to 50 million bushels in this report, similar to what they did last report. So if we could get below 2 billion bushel carryover, I think that psychologically would move the needle on the funds and their short positions as well.
Yeah. So soybeans, as we mentioned, maybe taking out some Brazilian weather premium, but we also have meal down hard here. Is that maybe a reflection of some of this news out of Utah about Smithfield and some of those contracts are not going to renew?
Yeah, I do think that. I think we're still, not still, but we are now back to wondering about the liquidation phase in hogs. We've got some bird flu in France. It seems to be getting more significant each day. I think the market's more sensitive to that protein demand from both the pork and the poultry. Notice what's happening is we still have, generally speaking, that pork and bean trade still very active. Hogs and soybeans trading very, very sensitive with one another in a similar fashion, plus or minus on the day. That suggests to me that they're both worried about China. It suggests to me they're both worried about the livestock and the meat demand and the consumption. This would make sense given the trade's also trying to price in Fed rate cuts in 2024. Why? Because we're going to be more difficult in terms of economic growth and recessionary possibilities, if not probabilities.
Yeah. And soybeans, January's trading below I believe the 200-day moving average. Lots of key moving averages here, now below the $13 mark. That's held us for a long time. How concerning is that?
It's very concerning because on the weekly chart, you don't have a lot of support underneath you until you get down around 1270, 1275. And then, you could stair step pretty quickly down. And this is where the agricultural outlook USDA did at the end of November. They took the exports of soybeans for the United States down to match the November WASDE report. They actually took the wheat and corn up above the November WASDE reports. And so the cattle and the soybeans still look very similar to one another in that the funds were very long on both tight supplies and strong demand. They're unwinding that. And that's where I think that they're continuing to unwind that long protein, short grain trade mindset that they've had most of this year.
Well, that tees us up for the cattle discussion then. Obviously, we're down here today, more technical selling pressure. And how much more of that do you anticipate in this cattle market, Mike?
I think the market is better balanced than it was, obviously 3 weeks ago in terms of the trade not putting in too much demand. And we just forgot how big the imports could be when other countries like Australia and similarly like Brazil have excess capacity to import into our country. Australia's drought in some areas are picking up their liquidation pressure. Their prices are going down, making them even more competitive to come into our country. But I think we've got most of this dialed in. I think the WASDE report numbers Friday could be as exciting or pertinent to the livestock market, cattle specifically, as the grains, because USDA came away on a November report of a 185 Q1 of 2024 average steer price. So we're a long way away from that, but the supply demand fundamentals would suggest we should be, I think, at least at 180 as we get ready to cross over into 2024. I also think we are having a good seasonal on the Christmas holiday. The beef retail numbers each week USDA puts out have met my expectations, which has been positive in my opinion.
Feeders, dealing with them specifically, hitting some new contract lows, and what a swift drop, almost $60 in the Jan feeders from the September high. Is the worst already programmed into that market too, do you think, or not?
I think from a cash perspective, it is, especially, Michelle, because the producers, cattle, cow-calf people needed to get something moved in this month, or if not late last month, and they just were forced into it. And so that's past us. I just am looking more and more technically and more fund-driven wise at the feeders because they held that 209, 210 level. January feeders trading 215, really close to where the January 2015 price went out on and expired. So if we hold 209, 210, I think that gives you sentiment that maybe would suggest we need to rebuild the price structure here as we get into the first of the year.
Okay. And hogs, as we speak, have tried to firm up just a little bit here, which is surprising considering the Smithfield news that you and I just talked about. But that market has also been really watching what's been going on in China as well. Again, do you think the worst is behind us? Can this market continue to heal off of last week's contract lows?
I was hoping the worst would be behind us by the time we get to the Dees Hogs and Pigs report. I'm still hopeful of that, but I'm not ready to say the market's likely got a low in or we're balanced. I mean, look at the cash trade right now. We're looking at around 54 on the cash carcass weights average price as of Tuesday, and we've got Dees Hog futures getting ready to go off the board in a couple weeks, or less than 2 weeks at around 66, 67. So unfortunately, we still have a futures premium against what the active cash bid is out there. I'm watching that CME cash index very closely as a result.
Yeah, it doesn't seem to be able to find a bottom here. That's for sure. All right. Thanks for joining us, Mike Zuzulo, Global Commodity Analytics. That is Markets Now.